Welcome to Introduction to Finance. In this course, we will cover the basics of finance and provide you with a comprehensive understanding of the financial concepts and tools that are essential for making informed financial decisions. We will start by discussing the fundamentals of finance, including the time value of money, the role of interest rates, and the different types of financial assets. We will also cover financial statements and financial ratios, which are important tools for analyzing a company's financial performance. Next, we will delve into the world of investments, including stocks, bonds, and real estate. We will discuss the risk and return trade-off, as well as the different investment strategies that can be used to achieve different financial goals. We will also cover personal finance, including budgeting, saving, and investing for the future. We will discuss the importance of having a financial plan and the different financial products and services that are available to help you reach your financial goals. Throughout the course, we will use real-world examples and case studies to help you understand the concepts and apply them in your own life. By the end of the course, you will have a solid foundation in finance and the tools you need to make informed financial decisions. So, if you're ready to learn about finance and take control of your financial future, let's get started. I'm your finance professor, and I'll be guiding you through the exciting journey of understanding finance and all the tools and concepts that come with it. If you have any questions, feel free to reach out to me. Let's get started. This course is designed for beginners in the field of finance and aims to provide a comprehensive understanding of financial concepts and tools. It covers fundamental concepts such as time value of money, interest rates, financial statements, and financial ratios. The course also delves into investment strategies, personal finance, and financial planning, with real-world examples and case studies used throughout the course to help students apply the concepts to their own lives. The fundamentals of finance include the following key concepts. Time value of money. The concept that money has a different value at different points in time, which is important to understand when making financial decisions such as investing or taking out loans. Interest rates. The cost of borrowing money is a crucial factor in many financial decisions. Financial assets. The different types of assets such as stocks, bonds, real estate, and other investments that can be bought and sold. Financial statements. Financial documents such as income statements and balance sheets that provide a snapshot of a company's financial performance. Financial ratios. A tool for analyzing and comparing companies' financial performance, such as the price-to-earnings ratio. Budgeting. Creating a plan for managing income and expenses in order to reach financial goals. Saving. Setting aside a portion of income for future use. Investing. Using savings or borrowing money to acquire assets such as stocks, bonds, or real estate with the expectation of generating income or capital gains. Risk and return. The relationship between the level of risk associated with an investment and the potential return. Financial planning. Creating a plan for achieving financial goals by managing income, expenses, saving, investing, and insuring. These concepts are the building blocks of finance and are essential for understanding financial markets, making informed financial decisions, and achieving financial goals. Interest rates play a crucial role in the economy by influencing the cost of borrowing and the level of investment. Central banks, such as the Federal Reserve in the United States, use interest rate policy as a tool to manage economic growth and inflation. When interest rates are low, it becomes less expensive for individuals and businesses to borrow money, which can lead to increased spending and investment. This can boost economic growth, but it can also lead to inflation if too much money is chasing too few goods. On the other hand, when interest rates are high, it becomes more expensive to borrow money, which can slow down spending and investment. This can help to curb inflation, but it can also lead to slower economic growth. Interest rates also affect the value of a currency. When interest rates are high, it can attract more foreign investment and make the currency stronger, while low interest rates can make a currency less attractive and weaken it. Overall, interest rates play a crucial role in the economy by influencing the cost of borrowing and the level of investment, and they are used by central banks as a tool to manage economic growth and inflation. The risk and return trade-off is a fundamental principle in investing, which states that the potential return on an investment is directly proportional to the level of risk involved. In other words, higher risk investments have the potential for higher returns, while lower risk investments have the potential for lower returns. Investment strategies vary depending on the investor's goals, risk tolerance, and investment horizon. For conservative investors with low risk tolerance and short-term goals, a strategy might involve investing in low-risk, income-generating assets such as bonds, savings accounts, and CDs. These investments may provide a lower return, but they also carry a lower level of risk. For moderate investors with a medium risk tolerance and medium-term goals, a strategy might involve investing in a mix of assets such as stocks, bonds, and real estate. These investments have a moderate level of risk and the potential for moderate returns. For aggressive investors with a high risk tolerance and long-term goals, a strategy might involve investing in high-risk, high-return assets such as emerging market stocks, venture capital, and high-yield bonds. These investments have the potential for high returns, but also carry a high level of risk. Additionally, investors can use different investment strategies, such as dollar-cost averaging, diversification, and rebalancing, to manage risk and achieve their financial goals. Dollar-cost averaging involves investing a fixed amount of money at regular intervals regardless of the price of the asset, which can help to reduce the impact of short-term market fluctuations. Diversification means spreading investments across different asset classes and sectors, which can help to reduce overall portfolio risk. Rebalancing is the process of readjusting the asset allocation of a portfolio to maintain the desired level of risk. In summary, the risk and return trade-off is a fundamental principle in investing, and the different investment strategies are chosen based on the investor's goals, risk tolerance, and investment horizon. Different strategies such as dollar-cost averaging, diversification, and rebalancing can be used to manage risk and achieve financial goals. Having a financial plan is important because it helps individuals and families to clarify their financial goals, understand their current financial situation, and develop a strategy to achieve their goals. It also allows them to make informed decisions about how to best use their financial resources, such as saving, investing, and spending, in order to reach their goals. A financial plan typically includes a budget, an investment plan, a retirement plan, a plan for managing debt, and a plan for protecting against financial risks. There are several financial products and services that can help individuals and families to reach their financial goals. Some of these include savings accounts and CDs. These are low-risk, liquid savings vehicles that can help individuals to build an emergency fund and save for short-term goals. Investment accounts, such as individual retirement accounts, IRAs, 401k plans, and brokerage accounts, can help individuals to save for long-term goals such as retirement. Mutual funds and ETFs. These are investment products that provide diversification and professional management, which can help to reduce risk and increase returns. Life insurance. This is a financial product that can provide financial protection for families in the event of the death of a breadwinner. Health insurance. This is a financial product that can provide financial protection for medical expenses. Retirement planning services. These can help individuals to plan for retirement by assessing their current financial situation, projecting their future needs, and recommending a strategy for achieving their goals. Tax planning services can help individuals and families to optimize their tax liability and minimize the amount of taxes they pay. Estate planning services can help individuals to plan for the distribution of their assets after they die, and to minimize estate taxes. In conclusion, having a financial plan is important to achieve financial goals, and various financial products and services are available to help individuals and families to reach their goals, such as savings accounts, investment accounts, mutual funds, ETFs, life insurance, health insurance, retirement planning services, tax planning services, and estate planning services.